Good evening, ladies and gentlemen. Jeez. Good evening, ladies and gentlemen. Yeah. Welcome to Investec Asset Management Taking Stock. Thank you so much for joining us. We did have about 800 people join us this morning. So we have opened out the afternoon session, and it's a little bit of a test case, so let's see how the numbers go this evening. We have negotiated for no load shedding during this presentation. We called Eskom and we said we've got the most astute advisors and their clients attending. For those people looking around, that would be you too. And they would help with the 400 billion rand debt that you have to cover. So let's see how that goes. For those of you who don't know me, my name is Sangeeth Sewnath. I will cover three areas. Firstly, a brief look at what the markets have done over the last year, an update from a business perspective, given some changes that we're going through, and then finally contextualizing some of the funds that we will talk about today. I will then hand over to Lindsay Williams and Sumesh. Sumesh Shetty, a portfolio manager at Investec Asset Management in the quality investment team. He will talk to what we're seeing in the markets and then specifically relating that back to the funds. He's joined in conversation with Lindsay Williams. Lindsay, a former TV and radio personality, and now a very insightful and entertaining business podcast. Finally, we'll have Jeremy Gardner. Jeremy has been in the business since the very beginning. He's an absolute legend for those of you who do know him. For those of you who don't know him, by the end of his presentation, you will understand why he is an absolute legend. These are some of the headlines. If we get into it, I'm not going to go through this in a lot of detail. This will be something that Sumesh and Jeremy will cover. But it did remind me of a quote that I recently heard. And the quote was something by Mike Tyson, which said that everyone has a plan until you get punched in the face. And that's what the last year has felt like, whether it's clients being punched in the face, advisors being punched in the face, and some advisors feel like their clients have punched them in the face. But if you are a client in the room, you should turn to your advisor and thank them for keeping you invested in the markets over these difficult periods. And we'll unpack exactly why we think that is the case over the previous few years as well as going forward. But this is what it has resulted in over the last year. These are returns till the end of December. You'll see the growth drivers in the South African market being equities as well as the property space, not really contributing to investors' growth returns over the year, and the only asset classes really giving you inflation-beating returns being that of bonds and cash. And this trend is not something we've just seen over the last year, but it spans 3 or 4 years. What is interesting in contrast, though, is if you look at the last 10-year returns, which is more textbook-like returns, it's more what you would expect, and to some extent, it kind of reaffirms why investors should be invested in the market. And for those of you who are relatively new to investment markets, you'll realize that double-digit returns are not really a myth over the long term. So the growth drivers being SA equities, foreign equities, giving you what you would expect and beating that of cash and bonds over the long term. But we realize that in these difficult conditions, people need a lot of encouragement investing in the markets. People are very despondent in terms of what they've seen. And so we try to help in this regard by providing some insight and some thought pieces around markets, reminding people of the longer term investment outlook. The first one is the darkest hour just before the dawn. You'll find this on our website. And the intention is not to give people the impression that we will see a massive turnaround in the next 3, 4, 5 months, but we believe that if you look back in 3 to 5 years from now, and if you're not invested in the market, you'll realize that that's probably one of the single biggest mistakes you have made. In my conversations with Clyde and the rest of the team at the start of this year, I have certainly not seen them as positive as I have for a very, very long time. But it's easy to be positive, it's easy to be optimistic. They have a very clear plan as to how they believe they will achieve those targets, which seems a little bit counterintuitive in these times, to be so certain. I mean, the clarity of thought that they have in terms of how they're going to generate returns is absolutely astonishing. But I will let Sumesh take you through that in a bit more detail. The other aspect, that narrative that's been part of the market, that's returned to the market, is around volatility. I'll give you a very quick example of what that means. In December, The US market, depicted by the S&P 500, lost 9% in a single month. That was the worst single month since the Great Depression. Now, if you left in December, gotten yourself out the market, you would have missed the full recovery of that return in January. Volatility is back. What it does remind us is that you have to take risk in order to get the reward for it. And we've forgotten that over the last few years. So we've created some insight around volatility, what that means, what we should be doing in these conditions, given that we expect volatility to be a big part of investment going forward. We've brought this back to the South African context. So what we've done here is really looked at the rolling 5-year returns of equities and the rolling 5-year returns of cash, and we've gone back to 1900. It's important to remind ourselves of what long-term returns look like, because our judgment has been clouded significantly over the last few years. So 3 things I would ask you to take out of this. Firstly, equities over the long term since 1900, giving you real returns of 8%. You will not participate in that return unless you are in the market. Cash over that period giving you real returns of 1%. Whilst people have hidden themselves in cash, it is not the long-term driver of returns for your investments. So that's the first point. The second point, which explains why you're feeling the way you do, for the first time, or for 1 out of 6 times in the last over 120 years, cash over rolling 5 years has outperformed equities. So not a very frequent occurrence, and that explains a lot of what investors have been feeling. But what is interesting, and that's the third takeout, is the extent of what equity markets do after such periods of time. And so you can see the spike each time after the rolling 5 years of cash have been below that of equities. A very quick business update. A lot of you start looking at your cell phones. I would urge you to spend 30 seconds just in terms of what this update means for you. It's very important. In September last year, we announced the demerger of Investec Asset Management from the rest of the group. It was a decision obviously taken by the shareholders and the board. Through this process, and a lot of these things are still dependent on shareholder voting and board approval, so there's some fluidity. The expectation is that we will list as Investec Asset Management around the middle of July. Thereafter, we will go through a process of a name change and an identity change, which we'll keep you aware of. Now, the first question I get when I speak to clients about this demerger process and the fact that we're listing is, will you be a boutique asset manager? And the answer is absolutely not. And actually, a very trusted and well-respected advisor who's sitting in the audience, you'll know who you are, came to me, and when I had this conversation with him, he told me, Sangeeth, the one thing you don't do is you don't sell yourself about who Investec Asset Management is. And so this slide, to an extent, is to help you understand what we've built as a business and how we've progressed over many years. It's a survey done by Charles Watson on an annual basis. These are numbers as at the end of December 2017. If you look at the independent asset managers that you'll be very aware of, Coronation managing assets of $50 billion. Allan Gray, so Allan Gray and Orbis report numbers separately. Allan Gray managing $32 billion together with Orbis in the region of $69 billion. The business that we have built globally, we manage $140 billion US. That's almost 3 times the size of Coronation and more than twice the size of Allan Gray and Orbis put together. So if you put that into context, the largest asset management globally is BlackRock, who manage $6 trillion. So very, very far off that. Second largest manager in South Africa, Sanlam, manages $73 billion. We are twice, or just almost twice the size of the second largest asset manager in South Africa. And I don't give you these numbers to boast who we are and what we've built. I give you these numbers to show you that we will be a formidable brand, we will be relevant, and we will not be a boutique asset manager in your clients' lives when we do list as a separate entity and when we do go through an identity change. So it's really just to give you comfort that we will be there, we will be very relevant in your lives, we will be very relevant in your clients' lives. And whilst markets have been very difficult, we need to make sure that we do not stand still. We continue to evolve what we offer and how we offer that to clients from a number of different respects. The whole process of demerge and listing has actually unlocked amazing energy within the people inside of the business. It has also brought a number of people outside the business who are interested in joining the entity that we're listing and will emerge or evolve into. So from a people perspective, just a few highlights. Dwayne Cable, formerly Coronation, been at Coronation for just over 13 years, managed the Coro Balance Defensive Fund. He joins Ziyaad Sumesh team. He will run the Investec Cautious Managed Fund in a few months' time, but a really good addition to the team, and we look forward to what he brings on. Brian Khan, one of the longest-serving members of the Reserve Bank as part of the MPC, already adding significant value to the investment team. We think it's very important to make sure that we get the right skills, that we continue to invest, we've got the right people, despite market conditions being relatively difficult. From a pricing perspective, given the challenging environment, we need to ensure that we're on the sharp end of our pricing, that we are relevant. These are some of the changes that we've made over the last few months. On the offshore funds, a number of our funds on a clean price available at 75 basis points. You will see an announcement in the next week or two. The Investec Global Multi-Asset Income Fund reducing from 75 basis points to 65 basis points. And then on the domestic side, the Diversified Income Fund at 50 basis points, Cautious Managed at 85. And then the last idea here really on the thought leadership, it is important for us to make sure that we provide the right insights to you and your clients. And apart from what I've spoken about earlier, we've done a lot of work around living annuities. If you haven't looked at this, I would urge you to have a look at our website. We think it's very relevant. We've gone through a lot of effort in producing this work, and we have found a number of other areas where we think we can evolve the work to be used by you and a number of your clients. And then finally, really just contextualizing the funds. You've seen this before, so I'm not going to spend much time on it. On the top half are the domestic funds that we have to offer. You know, the interesting trend, which you would be very aware of on the domestic side, is the allocation to fixed income funds. So the Investec Diversified Income Fund being a big recipient, one of the biggest recipient of flows on the multi-asset income sector. So that's been a big trend from a South African perspective. The three funds that we've spoken, that we will speak about are highlighted. These are the quality range of funds, doing relatively well last year despite absolute returns going through a difficult period, but importantly doing exactly what we would have expected it to do. And then if you look at this year, coming through really strongly relative to peers, given the strong return environment that we've seen. On the bottom half, you'll see our offshore funds, available in US dollar, sterling, and in rands. Two interesting trends, I guess, that we've seen on the offshore side in terms of offshore client allocations. Given the concerns around offshore global markets, a lot of people moving from high correlated global equity funds into more defensive global equity funds. So we've seen a fair amount of interest in the Global Franchise Fund, and then people very concerned about the global equity markets and the potential for a recession offshore, I guess, and moving from global equity into low equity propositions like a global multi-asset income type of fund. And then finally, hitting a number of milestones. Whilst we all look at short-term returns, it's important that we stay focused on the long term. Ultimately, you hold us responsible to deliver returns for your clients and to do what we say we do. And these are some of the milestones that we've hit over the last year or so. The Investec Equity Fund hit a 30-year milestone that it's reached, being the number one fund over that 30-year time horizon. And for those a little bit more cynical in the audience, there is more than one fund over that 30-year period. The Investec Opportunity Fund hitting a 20-year track record, being the number one multi-asset fund over that 20-year period. And despite the recent difficulties over that 20-year period, providing real returns of over 8% per annum. And then finally, the Global Franchise Fund, even though we've been managing that fund as part of the Opportunity Fund for a number of years, on a standalone basis, having a more than 10-year track record, and that fund being first quartile relative to a number of its global competitors rather than just the local SA global offering. So I'm going to leave it there. I would remind you to please sign out if you require CPD points. I'm going to hand over to Lindsay and to Sumesh. Thank you very much.